Okay, so Dow theory also has Dow patterns, so which we are going to discuss, and we are also going to talk about stages of a stock. So Dow patterns are mainly these patterns: double top, bottom, double top, double bottom, triple top. There is something called as ranges. It's basically range formation and flag formation. So we are going to discuss everything one by one. So these are few charts. So if you notice here, okay, at a certain price point, when a price point is reached, you can see a clear reversal. Okay, you can see reversals like this. Okay, now, so when you come across a chart wherein a certain point is reached, okay, so let's say this is the first point, and now this is the second point. Okay, and we can safely assume at this particular price point we have seen in the history that the stock reverses. Okay, so when these stocks are correcting like this, okay, and this particular price point is reached, okay, we can take a trade somewhere here. Okay, and we can calculate a target of this sort, so this high to this low. Okay, so whatever the price range is here, okay, that would be the target from this particular point. Okay, so let's say we buy somewhere here. Okay, so our price target would be somewhere here. Okay, now why we are assuming this? Because this is something has been the history of this particular stock. Okay, so this particular pattern, it's triple bottom. Okay, why? Because this is first bottom, this is second bottom, and this is the third bottom. And after this third bottom is created, we are sure that the price is going to reverse. Okay, similarly, exact opposite of triple bottom is triple top. Okay, so when the stocks start rising up, okay, at a certain price point, we know that there is a resistance. Then we have seen the downtrend into stock. After a certain point, let's say there was reversal because of some reason, let's say some moving averages here or some support is here. So from that, the stock price has gone up. So because this has been a very major resistance, okay, so at this particular price point, once it is meet the the trades starts reaching here, or once the market price reaches at this particular time, you can see there is a significant correction that happens here, and the stock market, the stock price starts going down. Okay, similarly, so this was my first top, this is my second top, and this was my third top. Okay, so from the history we know that every time the stock price reaches this particular level, the correction happens. So you can see in the third top level there is again a selling pressure, and stock corrects very rapidly. So this is nothing but just calculating about the resistances. So we know that this is a resistance because the correction is quite steep from here, and so this is a pattern. Okay, and we just care about the price points. Once they reach a certain level, we either buy in case of double bottom, and we sell in case of triple top. Okay, so this is again a triple bottom, and this is triple top. So let's say you created your buy position over here and you sat on the profit, you enjoyed this ride, and this will be your exit level. Okay, and you can exit and book the profits. Okay, similarly, let's say if this was your buying level, you enjoyed this ride and you can exit here. Okay, and let's say you want to create a buy position. Maybe you can take, let's say this particular stock is under your screener, and the price is correcting, and then that instead of buying at 100, I should be buying at 80 levels, and the stock price will eventually go up. Okay, so this is very important pattern. This is a triple top and bottom. Similarly, we have double bottom and double top. So almost the same. Instead of three tops or three bottoms, we have two tops and two bottoms. Okay, so this is my first top, this is second. So this is indicating a reversal from this particular price point, and this is the double bottom. So this clearly tells a reversal, a positive reversal that is going to happen. Okay, you can also see in this example there is this particular thing is called as rising star. You can see there is a doji that's created here, and it is confirmed by bullish Muromuzu here. And in the bottom, you will maybe notice, significant volume up rise in this particular candle. Okay, and that will basically confirm the up move will be there. Okay, and maybe you can have some resistance planned over here. That is why you exited at some point. Then we have range formation. So probably if you know the trade that we took in Crompton, so that was clear range formation, wherein a range is created, and the stock will just trade between the range. So it will correct from a level, it will come down, it will go up. Okay, it will maybe go sideways, then again come down, but it won't break these ranges. Okay, we call a range breakout when the stock breaches this particular range and closes above this range. Okay, so then this level will become my support. So now this is acting as a resistance, but when the stock price goes above, breaches this level and closes above this range, it is called as breakout, and this now will become my resistance. Okay, so stock will continue its movement like this. Okay, similarly, in case let's say stock prices come down and it breaches this level. Okay, so it is breaking its range if it closes below this level. Okay, so this is called as breakdown. Okay, because there is a higher selling signal, so stock prices will correct, and it will go down and down. Okay, so in case of range formation, somewhere here would be your buy levels. Okay, and it will give significant movement, so this would be your sell level. So range formation is something that intraday or short term positional traders like a lot, because they know that there's almost a confirmed chance of getting quick 5%, or in case some cases 10% as a quick profit, and they can quickly exit and shift money to some other trade. The important thing is they'll keep trading in the same stock for a couple of days. Okay, so they can they can do the first buying here, sell here, then again second buying here, sell here, again third buying here, and sell here. So they'll be constantly doing it. They just need to check whether your breakout or breakdown is happening or not, and as long as it is not, they'll continue to take trades into a certain range. So the range can be horizontal. Okay, it could be something like this, and it could be something like this. So ideally, this is the ideal case because chances of breakouts are much higher. So here, chances of breakout and breakdown are relatively higher, so we should be avoiding this. And here, chances of breakdowns are more than breakout. Okay, so this should be the primary range formation that we should look for. This should be second, and in case overall market breadth is very bad, maybe there could be some cases wherein you can take trend into range formation like this. So this is one example. You can see that this is range formation in the down market, and maybe this could be your buy point, and this could be your selling point. And after you can maybe you can create a short position here if you're comfortable with that. This could be your buy level again. Somewhere here you could have sold, somewhere here you could have sold your stock, and now you can see that price is not reaching to this particular level again. So these kind of deviations would always be there, but we should be very quick to exit or come out of that position. Okay, now you can see that here, though it's the markets are going down or this particular stock is going down, you can see that again here a rising star is here, and a Morobos is created, so which indicated a reversal signal. And you can see that it had came out of the range, it gave a very strong breakout, and it went till this level. Now you can see that this particular line over here is a resistance line. If I just draw over here, okay, so after this very strong move, you can see that there has been a correction that came little early than before touching this particular price, because the move has happened in very less time. So the less time it takes, there are very strong chances of stock correcting relatively faster. Okay, if it had taken some more time, there was more chances of hitting this particular level very fast. But even after this correction, you can see that somewhere here support was created. Okay, and the stock took support of this, it again reversed, and it started creating a fresh range over here, and this resistance also was taken out. It became a resistance, but again this was broken out and the stock continued the range over here. Okay, so these ranges and supports is something that can always tell us buy levels and sell levels. Also, let us not forget the moving averages as well. Okay, then we have flag formation. So flag formation is fairly easy to understand. So there is a breakout. Okay, there's a very strong breakout, and after that the stock price consolidates like this. Okay, so this somehow creates a pattern of a flag. Okay, if you just take, there's a pole of a flag, and then this is the actual flag. Okay, so this is bullish flag. Okay, and in case of bearish flag, so assume this to be a red candle. It has to be a red candle because that is how the correction is going to happen. And there is this very strong correction. This is a very strong fall. Assume these are bearish candles. This has to be red color. And after that the consolidation happens in this range, and usually after this the fall will be continued. Okay, so this is called as the bearish flag. So once this consolidation happens and the stock is not moving, it will start falling again. In case of bullish, what is going to happen, it is after a breakout there would be a consolidation and a upward movement will be created again. We'll talk about more patterns. Very popular two patterns are head and shoulder and inverted head and shoulders. So in head and shoulders, if you just notice that this is a shoulder, okay, and this one is a head, okay, and this is the right shoulder. Okay, so this is my left shoulder, this is head, and this is right shoulder. Now just to easily understand this, okay, so this is a certain price point, okay, or let's say this is a certain price point. Stock made a higher high, okay, then it made a low, but this low is higher than the previous low. Okay, so this is my higher high, this is my higher low. Okay, the next time when stock more creates a higher high, okay, why? Because this higher high is greater than this higher high. Okay, the price is has reached to a certain resistance level which is higher than this one. Okay, then it created higher low. Okay, why? This higher low or this low is greater than this low. Okay, and after that it created another higher high. Okay, because this is higher than this one. Now interestingly, it ended above the previous higher low. Okay, but now what has happened after this, it has created a lower high. Okay, so what this signifies, that once a short rally came, there was more selling interest over here. Okay, so that is why it did not take prices up and stock corrected very early. Okay, and once it goes below the neckline, okay, so this is called as neckline. Okay, so this line is called as neckline. It goes below the neckline with relatively higher volumes, so we can say that the stock is going to make lower low and lower high, lower low and lower high. Okay, so this is head and shoulder pattern. Okay, it is a bearish pattern, so this is a very strong trend reversal pattern. Okay, this is very general. So technically you don't nearly technically you don't really need to remember all the pattern names and what exactly the patterns are going to look like. There would be small variations, like this particular point is above this particular point, or maybe your head could not be tall like this, bigger like this. Maybe it would be somewhere something like this. So there would be variations in terms of patterns. But important is as long as you understand this higher high, higher low concept, you'll get to know that whether bulls are ready to buy at higher prices or not. And in case there is a strong selling that is coming from bears, the stock will have a difficulty going higher and higher. And these would be the initial signs of weaknesses wherein we should try to cut down our positions, or either reduce the position sizes. Okay, that will minimize the risk. Opposite to head and shoulders, we have inverted head and shoulders, which is a bearish pattern. So if you see, the stock has been making lower highs. Okay, so this was lower high, lower low compared to this one, and then this is again a lower high, and this is lower low. Then the stock corrects. Okay, and it, after creating this lower high, it creates higher low. Okay, why? Comparing this one, so this is my higher low, and it goes above, breaks the neckline, and creates higher high. Okay, so this was my previous high, it creates another higher high, and then it confirms the pattern by creating higher low. Okay, and after that the stock will continue its upward movement. So this, from this point till here, I got my first reversal signal. It was confirmed by higher low. Okay, and maybe this is the point. After crossing this neckline, you will see a very significant buying interest, and more and more buyers will join, and it will start to take prices up. And after mild collections, just when the price is going near neckline, there would be more sellers who would be interested, especially the one who have missed out on this opportunity. Okay, they will start buying, and this time the buying will be more, because everybody who bought here, exited here, booked quick profits, maybe shorted here, brought down the prices, and the more and more buyer will be here, and the stock prices will be shoot up again. Okay, so this was about head and shoulders, very prominent pattern that is usually seen in most of the charts. One of the most important pattern is called as VCP pattern, and VCP is nothing but the pattern which makes higher lows constantly, and it creates a lot of buying opportunities for many other retailers, other traders, or other market participants, and it creates certain emergency of buying. Most of the trades that we took recently were part of VCP pattern, because after a very sharp move, okay, what happens is many traders will be trapped at different levels. Either they are averaging, or maybe they were part of this up move, and a sudden drop has come. So maybe many have bought here as well. So after sitting on 30-40% loss, okay, they have forgotten about the stock. And after the reversal happens, everybody is waiting who have been bought here. Everybody has been waiting. Okay, fresh buyers buy here. Okay, assuming this to be a bottom, they think that okay, now we can make good money, so they'll buy here. Okay, now after the price reaches at this level, okay, so this could be some level, maybe previous support level, or maybe a moving average, so which will create this resistance over here, and there would be some selling pressures. But this time what will happen, the prices will not go below this point. Okay, so it will make a higher low. Okay, now here what is going to happen, more fresh buyers would come here thinking that the price is going to go up like this, and they'll get trapped. There would be existing trapping that had happened here, so you can see that there are more trapped players. The stock price corrects here. Now when it starts rising up, so everybody who missed buying at this level will start buying here. Okay, maybe these people will start averaging more, they'll start again buy. So you can see that again, these rallies, okay, these will be relatively faster. Okay, because there would be urgency in buying. Okay, everybody who is going to sell here are short-term traders or intraday traders who know that this resistance level has come, so they'll create a short. But again, system will create higher low. Okay, so you can see that this price would be higher than this one, and again there would be emergence in buying. So after these buying and selling, okay, which is going in upward direction, okay, there would come a point where there would be so much urgency that a lot of breakout traders will enter at this location. Okay, everybody who was playing over here would be in profit. They'll add to their position, fresh buying will come, and there won't be much shares available to buy, and everybody will want to buy this share, and it would be a very fast move over here. Okay, so this is called as a VCP breakout. Okay, so this pattern is VCP pattern. It stands for volume contraction pattern. Okay, so what happens here, so you have volume over here. Okay, and it creates very small segments like this, and it gives a very large breakout. Okay, again, let's say when it is correcting, there would be relatively lesser volume, and at a certain point there would be a very large volume. Okay, now why these volume spikes are coming? Because of volume contraction that is getting created, because less number of people are selling this stock, and that is why the buyers will want to buy at any given price. Okay, and usually the VCP breakout will have a largest volume candle here. Okay, so here is one example. Okay, so volume contraction is equal to T. We are just calling this as a T. And so previous base low, okay, so let's say this is a base. Okay, so consolidation is called as a base, will be less than the new base. Okay, like this. Okay, so you can see multiple bases are there. Okay, and after a resistance, you can see that in the volumes are going down. Okay, so these are called as pivot points. Okay, so these are ideal buying levels in case you want to be part of these T's. Okay, so the T's are basically these. Okay, or in VCP, these are T's. Okay, so this is 3T format. Okay, so this is first T, this is second T, and this is the third T. Okay, so in case we want to trade here from here till here, what we can do is at the lowest volume, okay, there is a very weak buying and selling. So or at those pivot points, so somewhere here we can buy, and you can see that in the consecutive days there would be a very large move that will be created, very strong volume that will be created. So you can see that this has been VCP breakout, and you can see after this breakout there has been a very strong move into the stock. Okay, so usually what happens here, the strong players will completely avoid this duration. Okay, so they are interested in this strong move. Okay, so in terms of this large move, they will buy somewhere here. Okay, once the breakout confirms, on the next day they will buy, and more people will try to join, because they know that this very strong move is already done. Okay, and they know that there is a large support, so this particular line which was a resistance will now act as a support. So they will buy here, keep this line as a support level, they will exit in case the stock price is going below this one, they will quickly exit, and they'll come out of the trade, or they'll be part of this large up move. So these are a few examples of VCP pattern. Okay, so one standard 1T pattern is wherein it's almost a range like this. Okay, it is just creating this range, and coming back, going up, coming back, something like this. Whereas in 2T pattern, if you notice here, okay, the first T has lower low, and the second one has the higher low. Okay, and after that, of course, it gives a breakout. Then we have 3T pattern, wherein these 3Ts are created again with higher loads. Okay, and it will give a breakout. Then we have 4T similarly, and 5T. Okay, so it's just like this. Okay, so this is 1, 2, 3, 4, and here 1, 2, 3, 4, 5. Okay, So the argument could be which one is the best among these. Okay, so this is good for small trades wherein the range is there and you want to do quick trades, constantly buy sell and be part take home the profits. I personally like this one because the less number of T's, which means the less time was spent by traders over here, and there was so much urgency that in this in the second T only it gave the breakout. Now there is counter argument that the more amount of range a VCP creates, okay, there would be less and less selling interest at this particular time. So this basically confirms as a very strong VCP pattern. But this again depends or this varies based on different time frames. There could be a lot that goes in terms of volumes or even the support that this particular pattern will have in terms of moving averages. Okay, but simply put, as long as your charts are showing these kind of patterns, those are very strong patterns, and there are relatively lesser chances of failure of this pattern. Most important thing about the pattern is that always remember that all patterns are just guiding information, and patterns are bound to fail. But as long as we know that pattern can fail, we can take care of stop loss levels, and in case the pattern succeed, the returns are usually very huge. Okay, so one trick, in case you're finding it difficult to find a pattern visibly, what you can do is you can create a 5-day moving average, okay, and keep source as high point, okay, not as the close. You can make it thick and dark in color, and you can just add this onto your chart, and you can quickly see that it tends to give you trend line like this. Okay, but with overall practice, I usually just suggest to avoid this. But with practice, of course, even on the normal chart, you will be able to see what is the resistance that has been created in the VCP. And most important point is to take care of reducing volumes like this on every T. Okay, if volume is not supporting this, okay, so there are high chances that this pattern is going to fail. Okay, so there has to be reducing volume at each T. Okay, so here is another example of pattern prediction, and so this is UPL, and it is a little difficult to find a reducing volume over here. On every T, there is no reducing volume over here. However, these are not T, so this whole figure is a T. Okay, why? Because the resistance has come here for the first time. Now, what can happen? It can create another T, okay, another one and another one, and eventually give breakout at somewhere at end of this T. Okay, and if the volume is, let's say, is going to go consistent like this, okay, so maybe there are high chances that the pattern might help. Okay, so this particular example I took way before, and this particular pattern has failed because volume somehow was not giving any indicators that it is going to give a VCP breakout. So this is the successful example that we had with a VCP pattern. This is CDSL. Just 1 minute. Yeah. So this is CDSL. You can see that this clear VCP was formed with 2T pattern. Okay, here, and after the large breakout, you can see that a lot of pivot points were created here. Okay, which gave a buying chance. Okay, at every T. Okay, and once the breakout came, you can see that the stock never came to this resistance level, and it shot up like anything. It gave us returns of almost 109%. Okay, the stock is now consolidating, okay, now a very strong consolidation phase, but it is not corrected yet very much. We are also expecting a strong breakout in the stock, so let us see how that particular trade goes. Important thing about pivot point, as I discussed, just before breakout, there would be reducing volume like this. Okay, you can see here. Okay, So there won't be any significant volume. So what is happening after every breakout, there are people who want to buy, there would be marginal selling, but because there is no much liquidity in the stock, there would come a time after each T that a breakout will come, and there would be less and less number of stocks which will be underselling. Okay. And you can also see that once this level is broken out, as in once the stock price goes above this resistance level, it becomes a support level. So you can see that after this breakout, stock went up, it corrected, but it never went below this level. Okay. Here just I want to add that you can see here the support level is somewhere like this. Okay. However, the stock went below this level, still closed above support level. It took the support of moving average. Okay. Here also on the next day, it took the support of moving average and somehow going up. So this becomes a very strong buy point. The reason being there is an additional support of these price levels. Plus there is a moving average that is traveling upwards. Okay. So it's a very strong buying point over here. So there are a couple of variations in VCP pattern. So the standard one, the 2T pattern, is called as cup and handle. So if you see, this is a shape of a cup, and this is a handle of that cup. So again, a fancy name. The pattern name is called as cup and handle, but it is underlying, it is VCP pattern only. Also in case of head and shoulders, so if it's inverted head and shoulder, you can see that this also comprises of a VCP pattern. Okay. So if you just assume this part, okay, so this again is a 2T VCP pattern. Okay. Then this is one really important pattern. This is called as 3C pattern. Okay. So it is cup completion cheat pattern. Okay. So what happens when the cup is under formation? Okay, there would be a sudden selling that would come. Okay, and it will still make a higher low. Okay, comparing to this point, it is a higher low. This one, it's still a higher high. Okay, but comparing to which point? So there is no point that we can compare over here. Okay, so this created a range for certain days. Okay, stock never went below your higher low. Okay, and it went easily above this particular point. Okay, it gave a breakout over here, and after that it went above like this. A fresh selling came here, and this time it did not went below this point. Okay, and then it returned to upward direction and eventually gave a breakout. So this particular area is cheat area, wherein the bear cartel will be active suddenly, and because they want to create position, they'll start short the stock very heavily, bring down the prices, and eventually start buying. Okay, so their interest is to buy at these levels. Okay, so they'll create money over here by shorting, plus they will double buy over here. Okay, exit their previous position of sales, create a fresh long over here, and take prices to upward. This could be another buying point for them. Maybe they'll sell here again, double buy over here. Okay, and eventually be part of this strong move. So this is another pattern, the 3C pattern, because most of the time what happens is eventually once most of us will think that it is not going to complete the VCP pattern, and eventually many will exit at this location. But this is the point wherein institutional buyers or strong players will start buying their position in between of these range. So how we can trade here? So as we said, we are ideally buying somewhere here. Okay, but if you still want to be part of this trade, what you can do is you can buy here when the range completes, because we don't know how many years or how many months or how many days this range is going to continue. So this range could be, let's say, of 10% only. Okay, so there are less and less number of chances that we can make money over here. So it's better that we move to some other stocks or wait for breakout here and enter here. Okay, we can take a small trade over here, book some profit here. On the correction, we can re-enter at this level, because we had anyways bought at this level. We can re-enter into this location and wait for a breakout, and eventually once it gives this breakout, we can add some more stocks here and be part of this upward journey. Okay, So this is how we can apply different strategies in 3C pattern, which is again a VCP pattern with a slight variation. So we'll talk about basics of patterns. So when you talk about patterns, it is more about where exactly those patterns are being formed, what are the ranges, supports, and resistances. Also, time frame makes important, and why. Let's say you are working on a, let's say, monthly time frame. Okay, when a single candle represents a month. Okay, and you somehow find a pattern wherein a double bottom is formed. Okay, and you get to know that the price might double in 10 or 12 months. So this would be a very strong chart. Okay, because you're working on a wide range there. Okay, so chances of succeeding into this particular trade would be really high. Okay, in the patterns, volumes matters the most. So when a breakdown or breakout comes, there has to be significant volume. Okay, and that is only the way of strong confirmation. Most important thing about pattern, always remember that patterns will fail. Okay, or they will break out. Okay, so if your studies are good, with practice you will see more and more breakouts. But in case you're missing out on something or some aspect of the pattern, probably those are going to fail. Okay, and it is not going to fail only for us. Of course, it is going to fail for many other traders as well. So that is why when the pattern fails, we have to be very quick to exit from the position. Otherwise, because everybody would be selling the stock on the failures of patterns, we should sell as early as possible. Okay, so that is the reason we should buy only on pattern confirmation. So this is the safest way. But again, the thing is, because the pattern is succeeding, we are not the only one who will be identifying that particular pattern. So once the pattern confirms, everybody will jump in to buy a particular stock, and probably we could be the last, or somewhere in the middle to buy a particular steps. And so that is the reason when the breakouts happen, we see rise by 10%, 15%, or sometimes 20% as well. So ideally we should be equipped in a way to identify patterns in early stage, and with a minimal risk we should be able to enter into particular script in the early stages only. Okay, so when a pattern fails, what people usually do is, let's say this was your VCP. Let's say you buy somewhere here. You're expecting stock to go something like this, but the reverse happens. So let's say what you do is you sell your position somewhere here. This was your stop loss, but this time you double your position. Okay, so you can just simply exit your position and go out of the trade by booking this marginal loss of, let's say, 2 or 3%. But let's say you buy 100 shares here. Okay, what you can do is, to be in profit, in case you're sure that this pattern is going to fail, you sell 200 shares. Okay, so what is going to happen here? You lost 2% over here. Okay, but because let's say the correction is going to be very stiff and stock falls by, let's say, 6 or 7%. Okay, you still make this 5% over here. Okay, so basically 5 minus 2, so you still make profit of 3%. Now if you are not sure how to do this and not comfortable with shorting, you can completely avoid. You can just simply sell 100 shares over here. Okay, while we are discussing the shorts, I usually suggest to avoid shorts and also FNO trading for at least 3 to 5 years of your initial technical analysis. The reason is, in when you, let's say, buy a share at 100 rupees. Okay, so what is the risk that we are carrying here? We can lose only 100 rupees. Okay, so let's say this stock goes to 0 rupees. Okay, and in case you don't exit, of course, it goes to, let's say, 0 rupees. Okay, and so your capital is gone. However, in case of short selling, what happens? So let's say the stock is at 100 rupees. You think that the stock price is going to go down. You sell the stock at 100 rupees. Now let's say the reverse happens. So let's say the stock goes to 60 rupees. So you make a profit of 60 rupees per share over here. Okay, but let's say the reverse happens, the stock shoots up to 150, you lose 50 rupees per trade. Okay, but very important thing about short selling is there is no limit on upside. Okay, it can go, it can make constant upper circuits, and it might go 40%, 50% in a day as well. Okay, and that would be a sure shot way to lose your capital in a day. Okay, so in case of buy sale, the downside is limited. In case of shorting, your losses are unlimited. Okay, but of course this may not be true for all the cases. In case, especially in case you're trading with non-FNO stocks, there are the circuit limits of 5%, 10%, and 20%. So at least you can exit your positions there. But for initial years in trading, you can avoid short selling and even FNO trading, because that requires a certain skill, certain expertise in terms of quickly exiting your positions. But shorting and FNO is again good way to make quick money, because as we know that when markets are negative, of course you cannot buy and sell. You can quickly short and make quick profits and go home. It is only the sideways marketing which is difficult to make money. Patterns take time to form. Okay, sometimes minutes, days, months, or years. But the longest time frame that they have, it will give the stronger breakout. Okay, and that is the reason when the time of breakout, there would be more and more interest in either buying or selling. Okay, because the stock will be in focus, it has been consolidating or creating a certain pattern over a period of time. Many people were not taking strong participation in the stock, but now because the pattern is about to form and it is going to break out or break down, many people will join hand and it will give a very sharp move.